Right, guys. So here we are. We have some other reliefs, as you can imagine, t- that you would expect. Typically, sole traders. I think that's where I want to almost go. This isn't really for people who are kind of employed. I doubt people who are employed would need this type of assistance. It's very much for people running businesses. So sole traders, in effect. So, as you can imagine, to protect, it does seem unfair that you would be running a business and you would, if you like, want to pass that business on, or you'd want to sell it and then it'd be a gain. So, imagine you started a little business and then, if you like, again, like you can see the highlight here is an unincorporated trading business. And then you're selling off, and then you have to pay these capital taxes, because that's how it works for individuals. There's no, it's just the annual exemption, and that's it really. So that's kind of the, or again, like I say, you might have shares in a personal trading company where you actually own, if you like, you're getting rid of your own shares, if you like. So but you're the main runner of this thing. You own more than 5%. You work in the thing. So really, this applies to people who work. They own a certain percentage of a company. They key employees, assets of a business within 3 years of ceasing to trade. So really, it's for business. I would imagine. That's the key point, really. Not your normal people who work a 9 to 5. So you're allowed up to 10 million over your lifetime, if you like, but you're allowed to charge at 10% up to 10 million over your lifetime, and it's always at 10%. So there are certain assets that qualify, the disposal of these qualifying assets, and I think that's the key point. The other condition, as you can imagine, you would expect, is that the assets must have been owned for at least 12 months, just to show that, it is a legit business. Additionally, for shares, the individual must have been working for the company for at least, if you like, 12 months. And it gives us some timelines by which to claim this relief. But here we are. So let's jump into it. Pretty much. So how does it work? Well, the focus is on this idea of the qualifying assets. We're really talking about business assets here ultimately, and if you like, I think the key point is that, because you see what we're trying to give here is 10%. We're trying to give you 10% over a 10 million lifetime band, so to speak, or allowance. So not every asset is going to be getting this. The key point here is that it's just trying to benefit that. So what we have to do is clearly separate out the gains using separate columns. And so because you're always going to get 10, the other thing about this is that it uses up the basic band rate immediately. So that's the other thing. You can't say, oh, it's not like residential where we will use residential first and then property. No. As soon as you decide to employ the ER, it uses up the basic band rate. We'll see a question in a second. But whatever other gains you have will probably get taxed at 20% if they're normal, or 28% if they're residential, if you see what I mean. But the key point here is we're really, and you'll see straight away, when you see questions, you'll see the nature of the type of disposals we're dealing with here. So look at this. This is a great one. So you can see this guy has a business called Mayor, and he's run the business for a long time. And this is what's happened now. He sold a factory, a retail. It's not a company. It's just a sole trader who's selling off his business, or selling off parts, businesses, or elements within the business that can run on their own, or a big share in this unquoted company. So what do we have here? It says that freehold factory, retail outlet, we have 120,000, and we have a loss there. So we have a net gain of 110,000. We have a net gain of 110,000. So naturally, of course, he gets his annual exemption. Remember, he's a sole trader, he's an individual. So knock off 11,700, and that brings us to the gentle figure of, is that 300 over there? You have 9, you have 8. And you have 98, yes, it's 10, yes, you have 98,300. And what are we saying here? It says that he's made no other disposals. Well, I mean, there's nothing else involved here, so everything just literally gets taxed at 10%. Right? It's always all at 10%. So if you like, that's the picture there. So you can see that, like I say, it's really, just think of someone running a sole trading business and trying to sell it. It would be unfair to start taxing them at 10%, and then at 20%. So HMRC give you this opportunity. Cool, great. So that's the first one. Let's carry on. Let me just get my notes together. Here we are, example 5. So let's carry on. So let's see another example. Good. And we have here, just to show you why we need to separate these things out clearly, Raymond, managing director and a sole trader of Polkadot Limited, a trading company. On the 11th, he has a shareholding, and he sells on the 11th of November. He sells his entire shareholding, resulting in a gain of 565,000. So he has, I'll just put here that he has this sort of business. I'll put business here, 565,000. And he subscribed for the shares in July, whatever, 1992. So that's okay. He's selling the shares in that business. His only other disposal is a painting. So I'll put here non-ER or non-business, and he has here a gain of 32,000. So he has brought forward capital losses. I know all of this will get the 10%. So what I want to try and do is it says he has taxable income of 31,500. You have to use the ER, I repeat that, against the basic band rate. There's nothing, it's gone. There's nothing you can do about it. So the best thing we can do is to use the capital losses brought forward of 1,600, bringing that down 004. 0, 0. Sorry, yes, then we have that. I'm just going to have to do that with my head. 006. Yeah, sorry. 6 minus 6 is 0. 32 1. So that's 31,000 first of all, and then of course we can take out his annual exemption allowance. And then we have 11,700, and here, oh, sorry, I missed that. That's not 32,000. That's 32,000. Sorry. So 32,000. Yeah, I was wondering what was going on there. So 32,000 minus 1,006. 32,000 minus 1,600. 0, 0. Bring the 1 there. 4, 0, 30. Take off the 11,400. Leaves you with 18,700. So you have a taxable gain of 18,700 on the non-ER or the non-business assets. And then on the business assets, because he's got a shareholding here that he's disposed of, what we now have here, well, all of that can come down, and all of this will get taxed, if you like, at 10%. That has used up, of course, the basic rate band. So all of this will get taxed. This is a painting, not residential. All of this will get taxed at 20%. Right, and that's the key point of how we deal with that. So this becomes 56,500 and 56,500, and this is 3,740. That's the picture there. Add those two together, and you have the total chargeable gains, tax payable. So that's the key point. I think what you want to do is, again, highlight, is just pick up, be very clear about this, just to highlight again, like I say, just really what we're dealing with here. Those assets, the qualifying disposals for ER, but you just sense them, you know straight away that we're talking about business. So all are a substantial part capable of independent operation. We're dealing with selling a business ultimately, and shares in a personal trading company, if you like. So that's the argument here. It's, yeah, sole trader business, unincorporated, fair enough, but also personal trading company. You would expect that, to be fair, they're just the main thing. But yes, he's incorporated, yes, but he is the main, he's an employee of the company. He's working a lot of the time. He holds at least 5% of the shares, and he's done that for at least 12 months. Um, right. Right, and I think that's that. Okay, great. I think I have some more time. Let me see if I go into is there an example 6? Let me see. I think I can just chuck this in here because I don't think we have a question on it, but I think it's important to know. So again, like I said, what you tended to have, this is new. When I say new, it will be applied this year, but we'll have to see how it actually works. But it's only an extension of entrepreneurs relief. So once upon a time, this relief was very much only available to people who actually owned businesses and ran those businesses, and that made sense. But what you started to have was you had a lot of people who would just invest in businesses, if you like, typically in trading companies. And it just seemed a bit unfair that when those shares now were ready to, typically, to encourage investment in business, the whole idea was to, in a way, to give some kind of relief, and then say, okay, listen, if you go away and you invest in these unlisted ordinary shares, and you hold them for a period of time. So you don't just, you actually hold on to those shares to enable that business grow, and then you decide to dispose of them. Then you can get exactly the same relief that we've just been talking about with entrepreneurs relief. Exactly the same picture. You can sell 10%, basic rate band, higher rate band. It won't matter. So now you can see that it meant that this came out in the 6th of April, or some 6th of April 2016. So it meant that for us to even tax any of this could only be tested. So students just knew about this. The only time this could really be tested would be, okay, 1 year, 6 April 17, another year, 6 April 18, and another year, 6 April 19. So potentially you could get asked about it, but it's exactly the same thing. And what are the conditions? Shares, if you like, invested in a unlisted ordinary shares in a trading company, including AIM. That's kind of slipped in there. Done before or after the 17th of March. You must have held them for a minimum of 3 years, and you're not an employee. So you're just. This is why I'm saying this is to encourage investment in these type of shares. So again, you have this limit of 10 million, and that's kind of the key thing there. It literally mirrors exactly what's going on with entrepreneurs relief. You don't have to actively be the person actually trading in that business, and you can have that as an investor relief. Cool, great stuff. I think that's enough on that one, and then we will move on to the next questions in the next video.